What if I told you that one of the biggest reasons people underperform in the stock market isn't because they pick bad investments, but because they believe they're smart enough to know exactly when to buy and sell? Today, we're diving into a question that has quietly cost investors billions of dollars over the years. Joining us is Dr. Ethan Carter, a behavioral finance researcher and investing psychologist who has spent years studying why our brains often become our worst financial advisors. Dr. Carter, here's my question. Why does timing the market rarely work, even though so many intelligent people keep trying?
That's a fantastic question because it gets to the heart of investing psychology. Most people think investing is a numbers game. In reality, it's often an emotions game. Imagine standing on a beach watching waves. You know another wave is coming, but can you predict the exact height, timing, and force of the next one? The stock market behaves much the same way. It has patterns over long periods, but day-to-day movements are influenced by millions of decisions, global events, economic data, politics, and human emotion. The fascinating part is that our brains hate uncertainty. We evolved to recognize patterns because doing so helped our ancestors survive. Unfortunately, that same instinct convinces us we can spot the perfect moment to invest. Sometimes we're right, but usually by luck rather than skill. This is where behavioral finance becomes incredibly interesting. Fear and greed constantly compete inside every investor. When markets soar, people feel invincible. They think, I should buy before prices go even higher. That's FOMO, the fear of missing out. Ironically, many buy near market peaks. Then the market falls. Headlines become frightening. Friends begin selling. Suddenly, the same people panic and sell too, locking in losses. That's loss aversion at work. Research consistently shows that people feel the pain of losing money much more intensely than the pleasure of gaining the same amount. Here's what's surprising. Even professional fund managers struggle to time the market consistently. If experts with research teams, advanced technology, and decades of experience can't reliably predict short-term market movements, what makes the average investor think they can? Take the COVID-19 market crash in 2020. Markets collapsed rapidly, and many investors sold, convinced things would get much worse. Yet one of the fastest recoveries in history followed shortly afterward. Those waiting for the perfect re-entry missed substantial gains. Warren Buffett has often emphasized that the stock market transfers money from the impatient to the patient. That's because wealth is usually built through discipline rather than prediction. Think of investing like planting a tree. You don't dig it up every week to check whether it's growing. You water it, protect it, and allow time to do the heavy lifting. Compounding works in much the same way. The longer your money stays invested, the harder it works for you. The real secret isn't predicting tomorrow's market. It's building habits that protect you from your own emotions. Investing regularly, staying diversified, ignoring short-term noise, and focusing on decades instead of days often produce better results than chasing perfect timing.
That's such a powerful perspective. The biggest lesson today is simple. Wealth isn't built by predicting every market move. It's built by staying invested when your emotions tell you not to. If you found this conversation valuable, hit the like button, subscribe for more insights into the psychology of investing, and tell us in the comments, have you ever tried to time the market? We'd love to hear your experience. Until next time, keep learning, keep investing wisely, and we'll see you in the next episode.